All right, what is up, everyone? Welcome back to the channel. Let's get right into it. The S&P 500, the NASDAQ, they're smashing all-time highs. The champagne is flowing on Wall Street, and the headlines are screaming bull market. But let's be real for a second. Does it feel like a roaring, healthy, everything is awesome kind of rally to you? Or does it feel a little weird, a little fragile? If you're feeling that disconnect, congratulations, you're not crazy. Because what we're seeing right now isn't the sign of a booming economy. Not at all. This is a very specific, very targeted rally, all driven by one single gigantic narrative. The market is absolutely convinced the Federal Reserve is about to hit the big, beautiful rate cut button, and this seismic shift is creating a battlefield with clear winners and losers. So today, we're not going to chase the headlines. We're going to be smart. We're going to dissect what's really going on, why a cooling job market is the spark that lit this fire, which sectors are getting left in the dust, and most importantly, where the next big opportunity is hiding in plain sight. And stick around, because we're also doing a deep dive on Alphabet Google and why its recent courtroom drama is the perfect miniature version of this entire market story. Let's get into it. The Fed's big U-turn. So, what's the big deal? Why is everyone suddenly convinced that Jerome Powell and the Fed are about to start slashing rates? It all comes down to one thing: jobs. The latest JOLTS report, that's the Job Openings and Labor Turnover Survey for the uninitiated, was the catalyst. It showed job openings dropping to a 10-month low. Now, normally, fewer jobs sounds bad, right? But in this crazy post-pandemic world, it's the perfect Goldilocks signal for the Fed. It tells them, hey, our rate hikes worked. The economy is cooling down, but in an orderly way, without a massive wave of layoffs. The ratio of job openings to unemployed people is now almost 1-to-1, down from a crazy 2-to-1 back in 2022. For the Fed, this is the green light. The mission to crush inflation is shifting to a mission to protect the job market from slowing down too much. And it's not just the data. The Fed officials themselves are practically screaming it from the rooftops. We had Minneapolis Fed President Neil Kashkari saying it might become appropriate to adjust rates soon. Then Governor Christopher Waller, a known hawk, came out and explicitly called for a rate cut at the next meeting. But the nail in the coffin was Fed Chair Jerome Powell himself at Jackson Hole. His key line: the balance of risks seems to be shifting toward the labor market. We're more worried about people losing jobs than we are about inflation right now. The market heard this loud and clear. The CME FedWatch tool, which is basically Wall Street's betting odds, is now showing a 90+% chance of a rate cut in September. It's a done deal as far as traders are concerned. This is the fuel, the rocket propellant sending growth stocks into orbit. The Great Divide, tech parties, banks weep. Now, a rising tide is supposed to lift all boats. But this isn't a tide. It's a targeted fire hose, and it's creating a massive split in the market. The winners, tech and communication services, your big tech and comms services sectors, are the undisputed champs of this rally. Why? It's Simple Finance 101. These are growth companies. A huge chunk of their value is based on profits they're expected to make years from now. To figure out what those future profits are worth today, you have to discount them back using an interest rate. When rates are high, future money is worth less today. But when the market expects rates to fall, that discount rate gets smaller, and suddenly all those future profits are worth a hell of a lot more right now. Valuations expand, stock prices go up. It's that simple. The expectation of a rate cut is a powerful steroid for tech stocks. And in the case of communication services, the sector got an extra shot of adrenaline when a judge handed Google a massive win in its antitrust case, sending the stock soaring and pulling the whole sector up with it. More on that later. The losers, financials, and energy. So who's paying for this party? First up, the banks. The financial sector hates the prospect of rate cuts. Their whole business model is built on the net interest margin, or NIM. That's the spread between the interest they earn from loans and the interest they pay out on deposits. When the Fed cuts rates, loan rates drop almost immediately to stay competitive. But the interest they pay you on your savings account, that's already near zero. It can't go much lower. So, Their profit margin, their NIM gets squeezed. Tighter margins, lower profits, unhappy investors. And then there's energy too. This one's a bit ironic. The very reason the Fed is cutting rates, a slowing economy, is a dagger to the heart of the energy sector. A slowing economy means less manufacturing, less travel, less demand for oil and gas. We're already seeing oil prices weaken because of it. So, the very macro trend that's boosting the rest of the market is the biggest headwind for energy stocks. Classic catch-22, the big play, skating to where the puck is going. Okay, so we know why the market's moving. Tech is up, financials are down. The obvious move is to pile into tech, right? Wrong. The legendary hockey player Wayne Gretzky famously said, "I skate to where the puck is going to be, not where it has been." Chasing the high-flying tech stocks right now is skating to where the puck is. The smart money is looking for where it's going next. And all signs are pointing to one long-forgotten, beaten-down corner of the market, small-cap stocks. Small caps have been absolutely hammered during this rate hike cycle. And the reason is debt. Unlike giant corporations, smaller companies rely heavily on bank loans, and a huge chunk of that debt, about 40% for the Russell 2000 index, is at a floating rate. So, every time the Fed hiked rates, these companies were like homeowners with an adjustable rate mortgage watching their payments go through the roof. It crushed their profits. But here's the beautiful part. What goes up must come down. The very same leverage that killed them on the way up is about to become their biggest superpower on the way down. As the Fed starts cutting rates, their interest expenses will fall faster and more dramatically than anyone else's dockins. Their profits are poised for a massive recovery. And here's the kicker. Bank of America's client flow data shows that in the week Powell gave his dovish speech, investors were still net sellers of small and mid-cap stocks. The herd hasn't caught on yet. This is a classic contrarian signal. The train is just starting to leave the station, and you have a chance to get on board before everyone else piles in. How to play it, the ETF triple threat. 1. The pure play, IWM eShares Russell 2000 ETF. This is the OG, the most famous small cap ETF. It tracks the Russell 2000 index, giving you broad exposure. The downside? The Russell 2000 has no profitability requirements. That means you're buying a lot of speculative, money-losing companies along with the gems. It's a great trading vehicle, but maybe not the best for a long-term quality investment. 2. The quality play, IJR eShares Core S&P Small Cap ETF. This is my preferred choice for most investors. IJR tracks the S&P Small Cap 600 Index, which has one crucial difference. It includes a profitability screen. Companies must have positive earnings over the last 4 quarters to get in. This simple filter weeds out a ton of the low-quality junk, leaving you with a basket of more stable, resilient small companies. Plus, its expense ratio is dirt cheap. 3. The sharpshooter AVUV Avantis US Small Cap Value ETF. This one is for the factor investors out there. AVUV isn't a passive index tracker. It's an active ETF that specifically screens for small cap companies that are both undervalued, the value part, and highly profitable, the quality part. It's a precision tool designed to capture exactly the kind of companies we're talking about, solid, cheap businesses ready to benefit from falling rates. It costs a bit more, but it's a direct hit on the thesis. The poster child, Google's great escape. Finally, let's look at Alphabet, because its story is the entire market story in a nutshell. For years, a giant dark cloud hung over Google, a massive antitrust lawsuit from the Department of Justice. The worst-case scenario was a forced breakup of the company. This uncertainty weighed heavily on the stock's valuation. Then, on the 3rd of September, the verdict came in, and it was a huge win for Google. The judge said, nope, you don't have to sell off Chrome or Android. And, crucially, you get to keep your multi-billion-dollar deal to be the default search engine on Apple devices. The market's reaction was explosive. The stock shot up over 9% in a single day. Why? because that giant cloud of uncertainty, that unquantifiable risk was suddenly gone. The moment the risk was removed, the value that had been suppressed was instantly unlocked. This is exactly what's happening with the broader market. The risk of a hawkish, rate-hiking Fed was the cloud. The JOLTS data and Powell's speech were the verdict that removed the uncertainty. And now, rate-sensitive assets from tech stocks to, yes, small caps are being rapidly repriced higher. Understanding Google's breakout is understanding this entire bull run. It's not about irrational exuberance. It's about the market paying a premium for certainty. The takeaway. So, let's bring it all home. This isn't a time to get giddy and chase everything with a green arrow next to it. It's a time to be deliberate. The market rally is real, but it's driven by the anticipation of a new monetary policy cycle. The old leaders might not be the new leaders. The real opportunity, the Gretzky opportunity, lies in skating to where the capital will flow next. And that destination looks a lot like high-quality, value-oriented small-cap stocks. They've been the biggest victims of rising rates, and they are set to be the biggest beneficiaries of falling rates. By using a disciplined tool like IJR or AVUV, you can position yourself for this powerful rotation without taking on the speculative risk of the broader small-cap index. In this market, confidence doesn't come from reacting to the noise, it comes from understanding the signal. The signal is clear. A major shift is underway. Position yourself accordingly. That's all for today. What do you think? Are you buying the small cap thesis? Let me know down in the comments. And as always, if you got any value out of this, hit that like button and subscribe for more deep dives. Stay smart, stay patient, and I'll see you in the next one.